Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform to the OECD's latest developments. I'm Doug McHoney, PwC's U.S. International Tax Services Leader. You can find me on Twitter at xbordertax. On this week's episode of Cross-Border Tax Talks, we're back in our D.C. studio, where I'm excited to have Tim Anson back on the podcast. After 38 years with PwC, including roles as the International Tax Services Leader in the U.S. and our Washington National Tax Services ITS Leader, Tim has recently announced his retirement. Tim, welcome back to the Cross-Border Tax Talks podcast, and congratulations on your retirement.
Thanks very much, Doug. Glad to be back for one last time.
All right. Well, Tim, before we dig into the new FTC regulations, you joined our legacy Pricewaterhouse firm in 1982. For the record, I was in second grade at that point. But you
I am an old man.
Right. You did that after as am I. After completing your accounting degree from Central Michigan University, the Chippewas, which I would not know if it wasn't for you. But I've heard in the past that you've analogized your career to the Star Wars trilogy. Can you share that with our listeners, kind of how international tax has evolved over the course of your career in three parts? And of course, this is the original Star Wars trilogy.
Yeah. I remember, I'm old, so I go back to the original, not the new stuff. It's funny you say that, Doug, because I kind of have before. I kind of cut my teeth as a Jedi in training, doing expatriate returns for individuals early on. So I learned the foreign tax credit and 9/11 exclusion, all that fun stuff. And then kind of further cut my teeth, so to speak, with the 86 Act, which, as we all know now, pretty much modernized the code to kind of accommodate the bigger and more complex investment that MNCs were making overseas. So I feel like I got in at ground zero on kind of the growth and development of the international tax profession. And it really got exciting, which is kind of the Star Wars phase, started with Check the Box in 97, right? Because that opened up a lot of opportunities for planning and adding value to our clients that, we kind of enjoyed for a good, 15 or so years, and even today. And then, when you think back, then, OECD and BEPS proposals to kind of clamp down on some of this planning might be analogized to The Empire Strikes Back a little bit. And so I kind of see the phase that we're in now as maybe the return of the Jedi, to make sure that, some of these proposals that are going on around the world, maybe not so coordinated and uniform, that we don't, have double and triple taxation for some of our clients. And that's kind of some of the planning that we're doing now to avoid a harsh result.
I love it. And that really encapsulates a lot of the things that we've talked about on the cross-border tax talks, because we think about some of the historic planning and structuring that was done. We've talked a lot about the Anti-Tax Avoidance Directive 1 and 2 in the EU, which is really BEPS 1.0. We think about BEPS 2.0, which we've talked a lot about potentially turning the arm's length principle on its head. And then now we're going to be spending a lot of time as advisors and thinking through how to avoid double taxation. And we spent a lot of time on this podcast. And I love that is the return of the Jedi, which unfortunately you will not be a part of. But you've spent so much time with many of us that you've passed the Force on. So we appreciate that.
Yeah, it's been a great ride. I've had just a blast. A lot of fun issues, working with smart people. It's just been incredible, and there's a lot of great work left to do. So while I won't be around, I'll be around in spirit, just like Ben Obi-Wan Kenobi, okay, looking over your shoulder.
I love it, Tim. All right, so let's turn then to our 600 pages plus of proposed and final foreign tax credit regulations. Maybe before we dive into some of the specific points that we want to highlight, obviously there's just a lot here, and so we're not going to be able to cover all of this in our 35 minutes, but certainly wanted to cover some of the highlights of the final regs, and then the proposed regs, I think, were really a big change and shocker maybe to a number of us in the industry. But any big picture thoughts or comments before we start to unpack some of the final and the proposed regs?
Yeah, as I sit here now, post thousands of pages of regs or whatever has come out, a lot of material, and kudos to Treasury. They've done a great job with a lot that needed to be done on a just widespread, comprehensive tax reform. So kudos to Treasury. But I sit back and I sit there and I go, many people, many taxpayers were hoping, for example, that GILTI would come out in the form of a min tax, with regulations, and that's not, as we all know, what happened. The GILTI provisions are really just another kind of foreign tax credit basketing set of rules on top of the GILTI rules themselves. And so, it's made it a very challenging, set of rules to deal with, because not only is GILTI kind of treated as like a FTC basket, but it's treated as as the worst basket you could have, or the worst set of rules, right? You have a 20% haircut on the credit. You don't get a carryover of your credits. So if you can't use them year to year to year, you lose them. And so, GILTI is a very tough provision to deal with, and it's far different than the min tax, which would not have, caused any residual U.S. tax against the GILTI inclusion, which is what many companies had hoped for.
Yeah, I refer to it as the casket basket. Because that's where the taxes go to die, right? To the extent that there are companies or excess credits in the GILTI basket, because there's no carry forward, those credits just obviously just fall off the table every year. And I think that there were still some taxpayers, advisors that were optimistic, hopeful, delusional, I'm not sure, that maybe they wouldn't have to allocate certain expenses against GILTI income. And I think that now, speaking of caskets, the final nail is in the casket. GILTI, we have to do expense apportionment. And so companies, even if they're paying greater than 13.125 from a blended perspective, still may end up with U.S. residual tax after expense allocation. Like, that is absolutely the case now.
Right. And so with that as a backdrop, you are going to continue to hear companies say, hey, we're getting hurt with expense allocation, because if you accept that we're going to have it, it's kind of hard to dial it back. Now, Treasury has done some of that, but I think many taxpayers would have hoped for maybe more relief on interest expense apportionment, which is the biggie. The new proposed regs did give a really good answer for most companies for R&E expense apportionment. Basically, none gets allocated to GILTI, and all of it gets allocated to general. For most people, that's a good answer. Not everybody, but some of the things that they're still going to hear that taxpayers want more relief or need more help, and you're seeing that in some of the preamble language where the Treasury has said, well, maybe we should think about capitalizing R&E and advertising expenses only for interest apportionment purposes. And I think the hope there would be that maybe that creates some big U.S. assets or non-FDII assets that would pull interest expense more away from foreign source or FDII. But some of these things, I'll believe it when we see it, if we get it. And then some of the things they're thinking about are kind of more Band-Aid type, fixes, and not the whole enchilada. So I just think that is the backdrop for companies continuing to think that there's an over-allocation of expenses, and they're facing a hardship that maybe they shouldn't.
Right. And that's been, I think, a relatively common theme throughout the number of these different reg packages. I think, Treasury should be commended for acknowledging a lot of those comments that we've seen within the final rules. They've obviously given a tremendous amount of consideration. But I think that many taxpayers would look at, particularly at least the foreign tax credit regulations, and frankly didn't get the relief, if that's the appropriate term, that I think many of them might have hoped for, based on the comments that they've provided.
Right. So I think that's where we're at, and hopefully we get a few more items of relief in future regs, and companies can kind of get to a good spot, but we'll have to wait and see.
Yeah, and I think the other big picture thought, and something that's really been interesting for me, is as we've gotten these new regulations, changing the models, running through the calculations, it's amazing, the complexity, and I want to unpack some of this. but it's, and particularly even at the CFC level, how complicated it is for every single CFC that effectively has to do these taxable income computations. And it's almost like its own mini 1120. It's not even almost like it's its own 1120 that we need to complete for each 5471. And so the complexity is just really, really, really dense. And then the collateral implications of some of these rule changes, we're still kind of seeing how the stuff pops out. And we'll unpack a little bit the FDII, some of the implications with the proposed regs. We call them boomerangs. I think we've talked about GILTI boomerang in the context of BEAD. I think there's an FDII boomerang.
Another boomerang, yeah.
There's just these collateral implications that, I call it like whack-a-mole. They hit one and then something else pops up. So it's just the complexity is just extraordinary.
And in fairness to Treasury, it's hard to see all of these kind of interconnections and things that do pop up. I mean, we're discovering it. I think some of them are new kind of revelations for Treasury too. So it's just a lot that has gone into these regs in a short amount of time. So you can't avoid it.
Yep. All right, so let's talk about the final regs. I think the general theme is that a lot of it was as expected. They obviously spent a lot of time with the proposed regs. They certainly acknowledged comments, but the final regs were largely as expected. But I did want to highlight a few certain provisions that I think our listeners should be mindful of. The first is with respect to branch IP and transfers between a home office, if you will, and the branch. Can you talk a little bit about that? How did those rules change, and what are some of the things that taxpayers should be mindful of?
Yeah, on that provision, the provision basically says if you have a branch and you transfer IP from the branch back to the U.S. head office, that they can, the regs kind of impose a 367D type reallocation of the IP profit back to the branch in perpetuity, pretty much. And people said, well, geez, what if we check the box on a CFC so it becomes a branch, for like a moment in time, and then the next moment, maybe a week or a day or a month later, you transfer the IP legally to the head office? Did you technically trigger this rule because you had a transfer of the IP by the branch to the head office, even though the branch didn't develop the IP and only held it transitorily? And so these regs provide some relief. They say, hey, we're going to call off this rule. We're going to let you transfer the IP to the U.S., really as if it went directly from CFC to the U.S. and it didn't reside in the branch for any period of time, so you don't have this kind of perpetual reallocation of IP profits back to the branch with the branch basket consequences and all that. So that was an issue that was coming up quite often when you check the box, and thankfully they've come up with a fairly reasonable approach to it.
Yeah, and to make sure that people are clear, the concept really is if there was IP in the branch and they wanted to leave that IP in the U.S., right, or leave that back at the U.S. group member that held the branch. Like if a taxpayer wanted to structure things in such a manner that they kept that IP in the U.S., then from a policy perspective, that's presumably what Congress intended. And so by creating the separate branch basket and this fiction between the branches, it created a number of headaches. And I think this is just very consistent with if taxpayers want to leave that IP, if you will, in the U.S., then they shouldn't have to deal with these collateral implications under this deemed 367D from the branch.
Right.
Okay, so one of the other things that I think has created really more complexity is the apportioning of expenses at the CFC level. So we know GILTI now, the Global Intangible Low Taxed Income, requires us to do a taxable income computation at each of our controlled foreign corporations. And so what that means now is that to the extent that there's interest expense, for example, at the CFC level, we need to apportion that between GILTI and the various other types of income, maybe non-GILTI, maybe Subpart F, but at each respective CFC level. And so first of all, the complexity is extraordinary as far as having to do one of these type of an expense apportionment calculation, which admittedly did occur to, I think, a lesser extent. Not every CFC had taxable income like we see now as far as, or impacting U.S. taxable income with GILTI. But talk a little bit about, those rules and, what taxpayers should be mindful of with respect to expense allocation at the CFC.
Yeah, a couple things that pop up is one you mentioned. So if you're doing an interest expense apportionment at the CFC level, the question was, well, what if the CFC owns other CFCs? Do you do the E&P bump roll up to the CFC with the interest expense and do the apportionment on the basis of that stock with the E&P bump at the CFC level? I think we all know you do that certainly at the U.S. level,
right.
but these regs make it clear that you also do it at the CFC level. So you're going to make an E&P bump at every CFC level that owns stock of other foreign entities that you need to make an E&P bump for. So it's not just a U.S. level calculation anymore. It's now at CFC level when you apportion interest expense. So, I mean, that makes sense.
Yeah.
I think that should be the answer. And but I think it just wasn't clear or intuitive to everybody in the past. So.
Right. And it does beg the question, because we spent a lot of time on the podcast talking about the MLI, the multilateral instrument. We've talked a lot about ATAD in the EU, CFC regimes. And so one of the things that I think a lot of taxpayers are looking at, the U.S. multinationals in particular, but really, even foreign-based multinationals, looking at tiers of holding companies and CFCs, and
right.
when we've got lots of tiered structures. And this is more of an administrative issue as far as doing these computations, but it does beg the question of, should companies flatten their structures? I think one of the challenges is oftentimes in acquisitions, which obviously we spend a lot of time with our clients dealing with acquisitions. Well, acquisitions just naturally come with tiered structures because
right.
you're typically buying a parented company with other tiers of entities, and it's just the complexity now that's involved both from a U.S. computational perspective, as well as we start thinking about non-U.S. CFC rules. And then we've devoted some time on the couple of podcasts ago on Pillar 2 and how if other jurisdictions start to implement GILTI, having those tiers of structures is just going to create a lot of complexity both from a U.S. as well as a non-U.S. perspective.
Yeah, and a related issue, Doug, let's say another issue. Let's say you have a holdco, CFC holdco, and it's got interest expense. Maybe it borrowed to make an acquisition. And so it's got interest expense, but it doesn't have any gross income, let's say. It bought another CFC target, whatever. And so the question had been, well, geez, if you have a loss at the holdco level caused by the interest expense and no gross income, and you're on the modified gross income method for apportioning interest expense at the CFC level, are we sure that that loss at the holdco level creates a tested loss or not? Because there's no gross income. And the regs make it clear that you ratchet up or you tier up tested gross income from CFCs down below the holdco for purposes of apportioning the holdco's interest. So that would make, if it's all tested income down below, the interest expense would create a tested loss, which could then be offset against another CFC's tested income, and you get the benefit of that. So
right.
they clarified that as well in the regs.
And that's because that is a very common acquisition structure,
yeah.
right? A company setting up a acquisition vehicle and then debt and equity financing that consistent with the overall capital structure of the company. So it's very common to end up with a interest expense at an acquisition vehicle, for example.
Right.
All right. So one of the other things in the final regs is, and we've gotten a lot of questions about this, are with respect to deemed paid credits, particularly where we have differing tax year ends for the foreign jurisdictions. So obviously, many non-U.S. jurisdictions, first of all, just require calendar year ends.
Right.
And so if you're a U.S. taxpayer with a fiscal year end, it's very common to have the year end of a CFC for local purposes being different than the U.S. tax year end. It can also happen with U.S. multinationals that have adopted an 11/30 year end, for example, for certain CFCs. And I think we had some concern with respect to where do some of those credits go depending on when they're assessed. How did the final regs address that?
Yeah, and what they say, so let's say you had 11/30 U.S. year end and 12/31 foreign year end. The question would be when the foreign taxes kind of accrue at 12/31, they really relate to 11 months of income that was reported in the U.S. year end 11/30. So the income's in a different U.S. year end. And these rules pretty much say that assume the income were earned in the year the tax accrues. So you assume that 11 months of income through 11/30 was earned in the year ended 12/31, whatever year for U.S. purposes, so that the taxes go into that. They kind of go into the right bucket. They match to the income because you assume the income was earned in the same year the tax accrued. So that makes a lot of sense.
Yep.
And it's got some interesting implications when you're talking about transition years going from 965 to tested income and all that. But it solved a lot of problems that people thought they might have before the regs came out, where they thought maybe we have to conform U.S. and foreign year ends to avoid a problem and losing 11 months of credit. So it's good, for the most part, a good provision.
Yeah, and that I think certainly a number of taxpayers found relief in that, particularly, if they're, depending on what their year end was for U.S. tax purposes vis-a-vis the non-U.S. So I certainly think that's helpful. So along those lines, foreign tax redeterminations. This is something that I think, I'm not certain that everybody really, or in the industry, understands how much of a change some of the 905C rules are with respect to foreign tax credit redeterminations. I think it's going to end, we're going to end up with, it's just amended returns are going to just be, almost annual commonplace.
I'm not sure people are ready for it.
I'm not sure people are ready for it. So explain to our listeners what has fundamentally changed and why we think this is such a big change.
Yeah, and so in the total of all the packages that came out, there's bits and pieces in different regs, but so we no longer have the pooling rules, right? So if you have a foreign tax redetermination, there's no pool to adjust, okay? So you have to take the taxes back to the year to which they relate. Now you can adjust the pool in the earlier year if it's a pre-TCJA effective date year. So there is an adjustment to the pool, but not a prospective adjustment to the pool. So that's what avoided the amended returns in the past, right? Companies would just pay tax and I'll adjust my pool prospectively and be on my way. Well, now you got to take it back, and you have to recalculate your deemed paid credits, whether it's a Subpart F income deemed paid credit or a 965 inclusion deemed paid credit. But you also, the regs say you get a deduction for earnings and profits purposes for that tax, that's redetermined tax. So that's a good thing, because if you took the tax back and only got it in your pool of credits, let's say for 965, but you didn't get a deduction to reduce your 965 inclusion, you'd get a bit of a whipsaw, because sure, you'd get the credit, but then you'd have to do a gross up, but you never got to deduct the tax unless they gave it to you. So they say that you get a deduction. So you're going to reduce your sub-F, reduce your 965, whatever you had, you're going to reduce the inclusion amount plus get the deemed paid credit. So, and then you'll do your gross up. So it all works fine. And so I view that as a favorable thing. But the point is, these are all amended returns. These all require amended returns to go back. And when you think about, there's a 24-month rule in 905C. If you don't pay the tax within 24 months, then it's deemed to be refunded to you, which is its own 905C redetermination requiring an amended return. And then when you ultimately pay the contested tax, it's another 905C redetermination requiring an amended return with different translation rate rules and all that. So your first point is the most important one, is that there's an administrative nightmare here, a lot of amended returns that people are probably not too focused on right now, but they will be soon enough.
Yeah, and where I think a practical implication of that, Tim, is companies where they just 965 want to have that thing in the rearview mirror.
Yeah.
Right? It was extraordinary complexity. This was the toll charge the companies had to pay for their deferred earnings and profits. We've obviously spent a ton of time with our clients, and taxpayers have spent a ton of time getting that math right.
Yep.
And then, and obviously want to be able to have that in the rearview mirror. But to the extent that there are foreign tax credit redeterminations, and particularly as we think about that 2-year rule, companies might have to go back and open up those prior returns to comply with the rules, and then query again, what are those kind of boomerang or downstream implications of having to go back and opening up those prior years where companies really just want to move forward and get those calculations behind them.
Yeah, you're not going to want to lose the opportunity to claim an additional credit, right? If you're contesting a tax, you're going to want to leave some of these years open.
Right. So I just think that that's just a practical implication that we're going to have to deal with.
Yep.
All right. So I think, and let's move to the proposed regulations. A lot of interesting stuff here in the proposed foreign tax credit regulations. I think maybe some more surprising than others based on some comments that Treasury had made before. But let's start with R&E. I know there were a lot of questions about how should R&E be allocated? How should those expenses in the U.S. be allocated between GILTI? We know that we got the rule in some prior regulation package with respect to look through from a basketing perspective, that royalties, for example, are general basket and not GILTI basket. Talk a little bit about those, the R&E and expense allocation, and how they tried to match the expense allocation with the treatment from a sourcing and basketing issue.
Yeah, so companies, as you know, were hoping that, or some companies at least, were hoping that royalties would be looked through GILTI, and that would alleviate the excess credit problem that most companies have for GILTI. And Treasury did not include that in the regs, as we know now. So royalties are general basket. But what they did do in R&D expense apportionment in these latest proposed regs, they said, well, the R&E expense of the U.S. company gets allocated and apportioned based on intangible income from that IP that's developed that hits the U.S. return. Okay, and so the intangible income that hits the U.S. return is defined not to include Subpart F, GILTI, or dividends. And those are pretty much the residual income earned by like a CFC who licenses the IP, right? Mm-hmm. But they're saying that residual income is not within the definition of intangible income. So that means that the intangible income that attracts the R&E expense is royalty income or sales income or services income, that the U.S. company would earn. But importantly, all of that income is general basket if it's foreign source. Royalties would be foreign source, as we just mentioned. If you have export sales where 862 or whatever, that's foreign source. Or services performed outside the U.S., that's foreign source. Or it might be U.S. source, in which case, fine, the R&E goes against U.S. source, and that's a good answer. And so for the R&E that gets apportioned foreign, all of it pretty much goes to general basket foreign source income, not GILTI, because GILTI is not included in the definition of intangible income. And that is very helpful for a lot of companies because, less expense against GILTI where they otherwise have excess credits, and it goes to general. Now, not everybody. I mean, some people they care about the general limitation. But so I think Treasury said, okay, we didn't give you the look-through on royalties as GILTI, but we're gonna allocate all your R&E expense to general and not GILTI. So that's some relief, and I think a lot of companies are happy with that result.
Yeah, and I think that one thing that, again, we talk a lot about modeling is that really understanding what some of the downstream implications are of having that R&E allocated to the general basket as opposed to GILTI. And I'll come to FDII in a minute, but the separate loss limitation rules obviously still apply. And so to the extent that there is a heavy R&E company that has a ton of research and expenditures in the U.S. and that expense is now allocated against general basket. Well, if it results in a separate limitation loss in that general basket, well, some of that loss then may slop over, if you will, into the GILTI basket to put you right back, to put the taxpayer right back where they were if that expense was allocated directly with GILTI. Right. And so it's, obviously each taxpayer is going to have to model it out. I think that for the most part, many taxpayers view that as a favorable result. But until you model it out, you may not understand what those other consequences are to the GILTI basket. Right,
and the R&E apportionment rules can be elected retroactively for 2018 and 2019 if you're on the sales method. So that's you can switch your elections, not be bound by the 5-year. You can kind of go between sales or gross income methods. So I think the R&E apportionment rules came out pretty favorably on the whole.
Right. So talk about that. We talk a lot about
for FTC.
Yeah, for FTC. So let's talk about the boomerang implications and some of those downstream implications, because certainly the foreign derived intangible income computation is also impacted by this.
Right. So they didn't come out with regs for R&E apportionment for FDII, but they did, as we just discussed, for FTC. And the rationale they used for FTC, if they use that same rationale when they write FDII regs, which is that R&E gets apportioned only to intangible income that's on the U.S. return, we said, well, most of that, if it's foreign, is going to be general basket, but it's also going to be FDII eligible, most, if not all, of that income.
Right.
And so if they use the same rationale, then an allocation of R&E to the intangible income could take a big slice out of your FDII benefit.
Right.
And so the worry is, well, geez, are they going to use the same approach, or would they come up with a different approach? And, you could kind of, I personally think that if they use the same approach for FDII, it's going to end up in an over-allocation of R&E expense to FDII. Because, you're basically ignoring all the other income that the IP helps to generate, which is GILTI or
Absolutely.
Subpart F or dividend income, which is not FDII eligible. So the hope is that they would think, although they said kind of the opposite in the preamble, but the hope is that they would think about maybe a exclusive apportionment approach for FDII, even though it hasn't been used in the past, for export incentives. But it could, that would end up with like a 50% if they use a 50% of your R&E performed in the U.S. is, going not against FDII, but to non-FDII, and that would be a great answer. But we'll see where they come out on this. I just don't think they've thought through all the implications of R&E in the context of FDII yet. But
yeah, and it's a great example of conflicting policies. We've seen this throughout the TCJA and Treasury's difficult task of trying to balance the various policies of the different provisions.
Right.
So we'll see where that one comes out. The next thing I wanted to talk about is about stewardship, because, boy, those rules have been around for a long time, and they've given us some additional detail. I mean, historically, I think taxpayers really any reasonable method, and I think from what I've seen, a lot of taxpayers have taken different approaches with respect to stewardship. But talk a little bit about the change to how stewardship should be apportioned between these various baskets.
Yeah. So, the old regs that have been out there forever just mentioned that you allocate stewardship to dividend income. You go, well, what about Subpart F or now GILTI? And these regs the proposed regs come out and make it clear that you allocate stewardship basically to the stock of, the stock investment of the subsidiary, which covers GILTI, dividends, Subpart F, everything. And so the problem is I don't think they've thought through all the implications of stewardship. So while they say allocate it based on stock, which covers all income from the stock, so maybe that makes sense, they haven't told us exactly what to do of stock of domestic consolidated group members. There's an example 18 they have in there where they have a U.S. subsidiary, but they say it's non-consolidated. And they say, well, because that entity would enjoy a 243 dividend received deduction, then the stock is eliminated. And so you go, well, geez, will the same rule apply to a consolidated group member given the one taxpayer approach under an asset method? And if you have to blow out or disregard the stock of a domestic subsidiary, does that mean you're going to get this huge over-allocation of your stewardship to foreign stock? And so that can't be the right answer. And I think Treasury knows that there's some, kind of flaws in what they've done to date. I don't think they've themselves delivered kind of the final chapter, and they want to hear from taxpayers on ideas, including what's the definition of stewardship. So, so right now we're sitting here going, okay, well, geez, if I have to disregard all of my domestic stock of the consolidated group members under the one taxpayer theory, then maybe this isn't even stewardship for the domestic subs because it's like a division. It's not oversight or duplicative costs with respect to a subsidiary under the fiction they're a division. Or you could say, well, it is stewardship because it technically or definitionally is, and so maybe we should just give you an asset for the domestic stock, even though it's treated as one taxpayer, under the affiliate group rule.
Right.
But even if you get to treat the stock as an asset, that still doesn't fix the problem you have because foreign stock has an E&P bump under an asset method, but domestic stock doesn't. So it seems like it's still going to be skewed toward an over-allocation to the foreign side. So I think they have to do a lot of work here, including defining what is stewardship. But that's a hard thing for them to do. That's hard to be prescriptive because it's kind of facts and circumstances. So I think the jury is out very much so on stewardship, other than we have an asset method that we're not sure exactly how to apply.
Right, and that is the fundamental change. Just to remind people that now stewardship has to be allocated like interest, and so you have to use this asset method. And you've raised what is a great point, which is like, what is that starting point for stewardship? You know, I spent a lot of time, particularly early in my career, analyzing, all right, well, what expenses should be charged out, right? Because there are specific rules within the 482 regulations as far as what should be charged out, and then what's that other pool of expenses, and then trying to figure out, well, what is quote unquote stewardship? Right. And so they gave us some additional insight with respect to how we allocate what that stewardship bucket is, but there's still the fundamental question of what even belongs in that bucket. Right. And I think it will be very helpful, particularly given the policy issues that you raised, for us to get some clear definitions on actually what goes in that stewardship. I think the last point on stewardship, because I do want to be able to move to these new -20 rules, is that, frankly, I think a lot of taxpayers maybe didn't spend that much time with stewardship historically because companies weren't FTC limited, and we didn't have the casket basket, which was GILTI. So a number of taxpayers would just take a very conservative approach with respect to stewardship, probably over-allocating expenses to general basket foreign source income under the good old days without really spending the time that maybe they could or should or need to now under post-TCJA. And so this is really just a kind of a blocking and tackling thing that taxpayers can do to potentially try to manage that issue with the GILTI foreign tax credits. But I think it's something really important, maybe something that hasn't gotten the attention historically it deserves, and certainly does under the new regime. Yeah,
I think a good old-fashioned headquarter study where you do the interviews and kind of unpeel the facts and all that are going to be really important. And especially now with GILTI excess credits, the expense allocation never had more of a negative impact than it has today.
Right. All right. So certainly last but not least, and this is probably warranted of an entirely separate podcast, but just want to spend a couple minutes on these new -20 rules. So we had an entirely new section or subsection added to the 861 expense apportionment rules. Can you give the listeners at least a teaser of what those rules were about and maybe a couple of the highlights?
Yeah, and so the kind of theme here is that Treasury doesn't like foreign taxes to be base or permanent differences. Okay, and they've had that approach for many, many years. Although the regs, the 904-6 regs, were kind of the rules to follow. A lot of people would say, I think these taxes fall into a base difference. And why did they say that? Well, because they would go into the general basket, and that was usually a good answer. So with that in mind, Treasury's saying we want to. So they defined a very narrow category of base differences. I mean, explicit, definition of item by item, and they're very, very uncommon, except a few 301c2 return of basis distributions.
And that's in the final regs.
It's in the final. Yeah.
Yep.
So very few base differences. Well, that then means they have to come up with all kinds of rules to cover everything else. Timing differences, and pretty much everything is treated as a timing difference. But you could have all kinds of examples. You could have a stock dividend that's not even a taxable dividend for U.S. purposes, but the foreign government thinks it's a dividend and assesses withholding tax. You can have disregarded payments, which are not income for U.S., but could trigger foreign income taxes. A whole host of different or income for U.S. purposes in one year, but the taxes in another year because of year-end differences, all kinds of stuff like that.
Right.
And so these rules address really everything but base differences, and they kind of replaced the 904-6 regs of old and, go over different fact patterns or scenarios to tell you how to categorize the taxes. And so, if I had to kind of summarize it in a nutshell, it's, for the most part, if you have income for U.S. purposes in one year but taxes in another year, the rules for the most part, tell you to assume that the U.S. income was recognized in the year the tax accrued. And then you categorize the tax in that manner. And then you got to hope that you have at least $1 of net profit in that category to be able to claim the credit. So that's kind of the theme that they've taken. Now, I think some people, maybe it was a false hope, but they were hoping that with this whole interpretation of the properly attributable to standard, that's taxes properly attributable to income, that maybe they would say, well, geez, if you have taxes in one year and the income is picked up for U.S. purposes in a different year, somehow you could allocate the taxes to the year that the income hits for U.S. purposes under a properly attributable to standard. They didn't go that far.
No.
They said, if we're going to start doing that, that's back to the pooling rules in effect, which I'm not sure that's true. But they didn't go that far. But I think what they did do was fairly reasonable. I mean, they kind of put the taxes in categories. They don't try to match taxes to specific items of income, more or less to categories. And if you have other income or some income in that category, at least $1, you're going to get the credit. So it's but if you have base differences, which are very narrow, as we said, at the CFC level, you don't get those credits. You just lose them. But you would get, if you have a base difference that's a 901 credit at the U.S. level, you'll still get that as a credit, but not 960s. So these are complicated rules. They didn't deal with all the fact patterns. There's a lot of interactions like of 909, splitter rules that aren't really taken into account by these 861-20 regs. And so there's questions on how those rules are. If you have a suspended tax under 909, do you then apply the inclusion percentage after that you remove the 909 suspended tax or before? I mean, you get some weird results. So I think there's some thinking left for them to do to coordinate some of these rules and to maybe cover a few fact patterns that they haven't thought of in these current regs. But not a bad job at all in what they did. Yeah,
and I think a lot of that will get flushed out during the comment period. So those rules that you are articulating are proposed rules, and so we've seen there's been a number of taxpayers and various stakeholders that have given a lot of comments in the past. I certainly think we're going to get a ton of comments on the -20 rules, and we just keep running into new fact patterns and interesting issues. Like the 909 is a great one that Treasury presumably will have to address in future regulations.
Right.
So, Tim, great discussion. Appreciate your insights on the FTCs. I want to thank you first. You've been a leader, a friend, a confidant, a mentor to many of us over the years. And while we will lose your wisdom and experience upon your retirement, through your efforts to develop our ITS partners across the practice, we will continue to get a bit of Tim Anson in a large number of our partners. An outstanding legacy to leave.
Well, thank you.
So on behalf of the entire ITS practice, Tim, thank you very much.
Yeah, thank you, Doug. I really appreciate it. Yeah, it's been a ride. I mean, it's been quite a joyride, and I feel my pension is in good hands with capable people like you and others. Just much good work left to be done. So,
well, thank you, Tim. I've enjoyed working with you over my entire 20-year career. So, thanks for tuning in to this week's episode of Cross Border Tax Talks. Thanks again to Tim Anson, our international tax partner in PwC's Washington National Tax Services Group. I'm Doug McHoney, PwC's international tax services leader in the U.S. Stay tuned in 2 weeks for another exciting edition of the Cross Border Tax Talks podcast.